Welcome to Factful Finance. Have you ever found yourself in a tight financial spot, thinking about taking out a payday loan? You're not alone. Millions of people turn to payday loans each year, but they can often lead to more harm than help. Let's break down what a payday loan is and why it might be best to avoid it. First, let's talk about what payday loans really are. Simply put, payday loans are short-term, high-interest loans meant to be repaid by your next paycheck. The loan amounts can vary, but the catch is the interest rate. These loans often come with fees that can be several 100% annually. For example, a $300 loan could cost you $75 or more in fees, and that's just for a 2-week loan. In essence, you're paying for the privilege of borrowing money for a very short period of time. Here's where it gets tricky. Payday loans are designed to be short-term fixes, but they often create long-term problems. Many people end up rolling over their payday loans, meaning they borrow more money to pay off the first loan, creating a cycle of debt. This can quickly snowball, leaving you in a much worse financial position than when you started. Let's put this into perspective. Imagine you borrow $300 on payday, and by the time your next paycheck rolls around, you owe $375. If you can't repay it, you take out another loan to cover that, adding even more fees and interest. It's easy to see how quickly this can become an expensive trap. So, why should you avoid payday loans? Aside from the astronomical interest rates, payday loans also don't help build long-term financial stability. They don't improve your credit score, and the debt can pile up, leaving you scrambling to make ends meet. Instead of relying on payday loans, consider these alternatives. First, build an emergency fund. Even small, consistent savings can create a financial cushion that prevents you from needing to take out high-interest loans in the first place. If you're in a bind, look into personal loans from reputable lenders, credit unions, or even borrowing from friends or family if possible. These options usually offer lower interest rates and better repayment terms. Let's take Sarah, for example. Sarah was struggling to pay for a car repair after her paycheck ran out. Instead of turning to a payday loan, she decided to reach out to her credit union. She was able to borrow the money at a much lower interest rate and set up a manageable repayment plan. Sarah's story shows how exploring other financial solutions can be a game changer when you're in need. It's also worth considering budget apps that help you track your spending mess, or even financial education resources that can provide you with strategies for avoiding debt traps in the future. Remember, it's not about borrowing to get by. It's about building a strong financial foundation. Before we move on, here's a quick reminder. This video is for educational purposes only. Always consult a financial professional for personalized advice that suits your situation. Now that you understand the risks associated with payday loans, take action today. What's the first step you'll take to avoid falling into this trap? Share your thoughts in the comments below. We'd love to hear from you. Thank you for watching this episode of Factful Finance. Don't forget to like, subscribe, and hit the bell so you never miss a financial tip. Until next time, stay informed and make smart financial choices.